In a world where everyone is a consumer, now, whenever you buy these products or these goods, you're not just making money for the company, but you're also making money for the investors like me and you. You see, now, this particular group of companies, yes, I call them group of companies, returned the highest profit last year. And from what we are seeing, they are going to do the same history again, make millionaires and multi-millionaires. Welcome to Clockwise. Today we'll be discussing five consumer staples that are likely to make multi-millionaires by the end of 2026. We'll be doing a critical analysis of it from their fundamentals to everything you need to know. And I have my guest as usual. My name is Providence, and my guest is someone that has always been here and will always be here. Please, with a resounding virtual round of applause, welcome Mr. Kandel. Welcome again.
Thank you very much for having me.
Always having me.
For always having me.
you.
Okay.
All right.
For always having me.
Now let's start from what happened last year.
Yes.
First, people don't understand these are hidden financial, should I say, money printing areas. You see, we are all consumers. You consume something. Consumer staples is a must as far as human. In fact, when you look at the hierarchy of needs, it's one of the needs of humans as human beings. And people are making money, so much money from it. Investors and the owners of the company. So let's look at it. Let's first of all look at what happened in 2025 before we now see the projection of 2026. What really happened?
Okay, thank you very much. Consumer staples, that's a category that a lot of people have overlooked. You go out, you buy a bottle of beer that's maybe produced by one of those names, but you're not thinking about making money from what you're buying. So that is one thing that a lot of people have not thought about. But that sector returned, ready, 130%. It's the highest, it was the highest profit sector in 2025 in the Nigerian exchange group. So it actually returned 130%. In fact, there were some names that was really very high. Yeah, and I'm going to tell you exactly why. So it returned 130%, and even some names particularly did 3 digits. We are going to look at a few of them, but that was a very impressive return last year, and of course there are reasons why we had those returns. Some of them did what we call a recovery rally, because if you remember, these guys have been suffering from the brunt of FX liquidity issues. Most of the names, most of the Nigerian consumer staples are actually very import dependent. And when you had the dollar go on a runaway, spike against the naira, it actually affected their margin so much. So there was a terrible margin compression for most of these names. 2024 and 2025, early part of 2025, when the dollar was, but with the exchange rate, that's Naira appreciating against the dollar, they had a very good run last year. Because if you look at, they began to see a lot of margin expansion.
Okay.
Before
we list the names, let's look at what they are doing now currently, year to date. How is it going for them?
So a lot of them, some of them have actually returned over 50%. Already.
Now this is just a
over 50%. Yes.
Wow.
That is in the first quarter of 2026. So they are still on that recovery rally, because I mean, if you look at the FX market, there is that stability. The reality is that if you look at the major names, they import either semi-produced or semi-finished or raw materials from overseas. They buy it in US dollars, they process it in Nigeria, they sell it within Nigeria. Some of them also export it. So if you look at, but their major market is in Nigeria. So if you look at that, then that tells you that a high FX exchange rate will affect because their margins, they're buying expensive, expensive product or inputs, and they are producing and they are selling to a market, a Nigerian market, where you can increase your price so much.
Now let's go one after the other. Now let's look at them one sector by sector, one after the other. So what should be the first one for you? What's your first pick?
So the first one for me, so the way we look at consumer staples, we look at it in 2 categories. We look at what we call core compounders, and then we have what we call high beta plays. So the core compounders are the ones that you can actually, like, they are generational. That's they guard your portfolio. They are not
They're like
names.
defensive.
They are like the defensive, but they are still. When people hear about defensive, people think about
Very
low,
defensive.
low returns. But some of these names are very strong. What I mean by they are robust. They have a very strong market dominance. So that what that means is that they are not so much. They are not, compared to others. They are not as volatile. So we have the core compound. We have the high beta growth plays, which those names are, some of them are in a recovery rally, some of them were beaten down, and they're in a recovery rally. So we are looking at in both ways. So I'm going to start with the core compounders. The first name I'm going to mention here is Nestle. Nestle. Nestle is a core compounder. Last year we had Nestle returned 123%. In 2025,
123%.
123%.
That was higher than even the total NGX.
So that's the point. So that's why I told you that these are some of the names that people don't look at. A lot of people, if you look at in the media, people talk about oil stocks, the people talk about bank stocks, but the reality is that there are some names that are in the background that are making insane amount of money. So Nestle. So Nestle is also a strong dividend payer, because beyond consumer staples for us is we are leaning towards those guys that actually pay dividends. So it paid huge dividend. I think the dividend yield sits around 5%. There's something we call return on equity. Return on equity for Nestle is over 60%. So that's why we call them core compounders, meaning that they can sit in your portfolio and really help your portfolio to grow. Because of very high return on equity. Then if you look at the margins, their margins, they had above 40%. The margins, which is, and when you look at margins especially for FMCGs, you look at their margins, because the margin is actually what actually sustains them. So high margin, high return on equity, and then you have dividend yield. Or the dividend yield is 5%, which is, if you look at the list that we have, is about the lowest. But I mean, because of the fact that you look at other numbers like the return on equity as well as the margin, that actually compensates. They have what we call a pricing power. So, and they have actually benefited so much with the stability of the US dollar. So, because we expect the naira to continue to remain stable, because especially Dangote is coming in, is actually bringing in a lot of foreign exchange, and then the FTSE has actually re-rated Nigeria. Nigeria is back onto the global index. In fact, analysts project $1 billion to come in over the next 6 months.
So now, from the charts, is it a nice place to actually do a buying?
Yes, it's. I look at it. It's a nice place to do a buying, and the reason is not because it's the best that we can look at, because I mean it's done 123%. So you might expect some correction, but the thing is, you look at the tailwinds. The tailwinds are way higher than the headwinds that it's facing, because I mean Nestle, like I told you, has a high pricing power. It has, and if you look at it, it also has. There's FX stability, meaning that Nestle can afford to import and still maintain that high margin. So margin expansion is what I think would drive.
We'll show the chart.
We'll actually put it up.
That's
so
number two.
Then number two will be BUA Foods.
BUA Foods.
Yes, BUA Foods. BUA Foods is also a very, very strong core compounder. Returned 92% last year.
Entry point.
Is that
entry point?
No. I'm saying the return on investment last year. Yeah, it returned to 92% last year. It actually it has a very good, a better dividend yield. It has a dividend yield of 6%, which is, for me, it's appreciable if you look at it. It has gross margin is still high, 25 to 30% gross margin. Then return on equity is also comparatively high. It's over 40%. So it's also a strong name. Now, I'm saying strong name because BUA Foods also has that pricing power, and it also benefits from the same tailwinds that we talked about for Nestle. So and then BUA Foods particularly does what we call vertical integration. You see, one of the things that actually helps, especially FMCGs, to make is margin. when your margins are good, then you can actually, and especially for BUA Foods that does vertical integration, meaning they have a lot of in-growers that help them to, and then they integrate upwards. They don't just go round, unlike a few other names. They don't just go import these things, semi finished products, and they also have in growers within the country. And you look at when you can buy very cheaply from Nigerian, from in growers, and then you are able to add value and sell at a high margin. So that's one of the things that works very well for BUA Foods. So Nestle, BUA Foods. Then you also have Dangote
Foods.
No, that Dangote Sugar, Refinery PLC. So Dangote Sugar is also a strong name that I think people should look at. Last year, it returned 100%. It had 100% return on investment. That's high. Nestle was 123. BUA was 92. Dangote is 100. And then Dangote also has some good backward integration. So which also works well for it. Dangote has in terms of dividend yield is about 9%, which is very strong. 9% dividend yield is a very strong number. So compared to Nestle has about 5%, BUA has 6%.
Is it a right time to actually do a buy-in into Dangote Sugar?
I would still have it on my radar, actually. There are still a few technical levels that I'm actually looking at, but it's a very strong name. A strong name because Dangote has consistently paid, Dangote and Nestle, they have consistently paid dividends. Okay. So sometimes, especially when you do with these consumer staples, when we talk about is it a good time to buy, it's a matter of what are your preferences. Are you looking at return on equity or are you looking at dividend yield? Okay. If I'm looking at dividend yield, then it's a good time to buy. Almost every time it's a good time to buy. Yeah. Because I'm looking at dividend yield. But if I'm looking at return on equity, then I could look at some support levels. Because dividend yield, that's why I mentioned all of this as core compounders. Because dividend yield actually gives you, whether you buy it January 1st, if you buy it January 1st, at any time you buy, actually, you are still definitely you are hunting for dividends. Yes, but when you talk about return on equity, then you are looking at a price point for the stock that you want to buy such that when it goes up, you have some decent return. That's number one. Number two, for Nestle and Dangote, for example, I'm looking at this as long-term plays. Long-term plays meaning that these are guys that are very stable. So what that means is that you can even consider them as defensive to some extent. Maybe Nestle, BUA, and Dangote somehow defensive, because can you stop eating?
No, consuming will actually continue.
You always want to eat, whether you are in a recession or not. So this is not a luxury good or a consumer discretionary. So for that, I think Dangote Sugar does the margins are very good. The dividend yield, like I told you, is 9%. The return on equity is also good. It's about 25%, which is still good. Because if you look at the 25% return on equity as well as 9% dividend yield, that's a good number for you to look at.
We have Nestle, BUA Foods, and Dangote Sugar.
Yeah, Dangote Sugar. The fourth one, people think it's controversial, but I think it's also good. And I'm going to tell you why. It's Nigerian Breweries.
Okay.
Nigerian Breweries. And I'm going to tell you why, particularly this year, I would actually be rooting for our listeners to really consider it strongly. Nigerian Breweries is a very strong name, of course. It's a very strong name. It actually did 135%. Think about it. Not 125 123 that Nestle did, but 135% in terms of return last year. And if you are looking the way I'm looking, then you know that if this year we'll have more. Here is why. Remember that this year is a World Cup year. And when people sit around watching football, what happens on the table?
A lot of drinking.
So there will be a lot of drinking. Yeah. So in fact, the last two names I'm mentioning now has to do with drinking. So you have Nigerian Breweries is going to make a lot. We expect it to make a lot of money this year. to the stock price to actually move up. And then Nigerian Breweries also pays the dividend very consistently. So if you are looking, whether you're looking at building a dividend stock portfolio, whether you're looking at building a defensive stock portfolio, or whether you're looking at building something around the consumer staples that we're talking about now, you are looking at Nigerian Breweries. Now, like I told you, the World Cup is coming, so that's a very serious tailwind for the Nigerian breweries. And then they also have that some very strong pricing power too. So we expect some margin, and Nigerian breweries is coming off of a very serious margin compression. Very serious. Let me use the word depression, stock depression. So we expect a lot more rally. The next name I'm going to mention, after Nigerian Breweries, is even a higher beta play, and all that. So Nigerian Breweries is expected to return a very high yield this year, especially because this year is a World Cup year. That's Nigerian Breweries.
The fifth one?
Then the fifth one is Guinness.
I was actually expecting you to say Guinness.
Guinness.
Because it can't be World Cup.
Guinness is not part of the core compounders, actually. It's a high beta recovery play. So here is why. And by the way, let me mention this. Guinness did an insane return last year. You ready? 398%. That's what Guinness returned. Let me give a context. If you had invested ₦1 million in Guinness
last year,
you'll be sitting at, you ready? 498 million.
Shit.
So if you invest 1 million, let me explain further. 1 million, 100% is 2 million. 200% is 3 million. 300% is 4 million. 398% is what? 4.9 million.
Man. Just 1 year. So
that's exactly what happened, and that's because it is a recovery rally. It had structural issues, and then that's why I always say you look at some undervalued. So, but I believe that those numbers will smoothen out. But there's still an upside. You might think, okay, so we are expecting a very sharp correction. Yes, of course, I know that we might have some correction. That's why I've always said on the channel, dollar cost averaging. You cannot afford to really YOLO into any asset with everything you have. Okay, so dollar cost averaging. But I'm still expecting Guinness to do something this year, and the reason is because Guinness, this is a World Cup year, and Guinness has products that actually appeal to people around sitting on the table watching football. But I expect the returns to smoothen out because that was a recovery rally. So in terms of return on equity, it's been performing very well. So a few other things that you might be looking at would be that Guinness has a broad-based distributor network, is insane. They have a brand image. So those are some of the, especially for fast-moving consumer goods, you're looking at things like the brand image, because I've seen a number of times where people will go and say, I'm looking for this particular brand of beer. Okay, so you're looking at that. They have that distribution network. They have the FX liquidity issue, the FX exchange issues. It's normalizing, and Guinness does a lot of importation. Its production is actually heavily import based. So if the FX is smoothing out, then you could be looking at a very good run for Guinness.
Okay, those are the 5 now.
Yes.
Nestle,
BUA, Dangote Sugar. Then you have not Champion Breweries.
Okay, sorry.
Nigerian Breweries,
yes,
and then Guinness.
I don't know why I have a problem with Champion Breweries. Don't worry, after the program I'll tell you what.
Which, by the way, a lot of people earlier this year they did some. Let me just say recently a lot of people have been calling me champion when we want to invest in champion Breweries and all of that. So, but we want our investors on this channel to be very educated.
Yeah.
You don't just drill into them because you see it on TikTok or you see people talking about it.
Or on Twitter.
Always look at the fundamentals. We try to spend time to talk about fundamentals here.
That's why we are here.
Uh-huh. So now, after now, we'll now talk about how I would structure my portfolio if I was to really look at some of these 5 names.
Yes. All right. Now, before we actually go, let's have some few words from you.
Okay, so let me speak of that. So I would actually want to do 50 to 60% in those core, especially Nestle and BUA Foods.
Okay.
Yeah, because these guys can keep your portfolio, especially for a beginner. Because a beginner would not want to see 30 to 40% dip on their portfolio. So you want to look at 50 to 60% in the core. Then you could look at between another 20%, 20 to 30%, 60% in the core.
That's Nestle.
Nestle and BUA Foods.
Foods, yeah.
Then you could look at another 20 to 30% in Dangote. Dangote, because Dangote pays dividend consistently. Dangote Sugar Refinery. Then you also look at the rest allocation going into Guinness and Nigerian Breweries. That ensures that your portfolio is resilient and well guarded, and you don't also miss out on the gains that we expect this year due to the football season that we are going to have.
All right, that's a very nice one for us to leave it here. I think we'll do another analysis of it. Let's see if actually got it. Although we are going to put the
charts, yeah, for
so
all
you
of
see
those.
what we're actually seeing and see that we look at these fundamentals both technically and fundamentally. Now, on that note, we'll come to the end of today's episode of Clockwise. Welcome again.
Thank you very much.
Thank you for coming. And please do not forget to like, subscribe, and also put on the notification bell on this channel, because every week we bring amazing content. And also do not forget that the illiterate of the 21st century are not those who do not go to school or those who will not go to school, but are those who have refused to evolve and their environment is evolving. My name is Providence. I'll see you again.